Welcome back. In our previous presentation, we introduced two important propositions that were developed by these clever researchers in the 1950s, Modigliani and Miller. The first proposition that they came up with was that in a perfect capital market, changes in corporate leverage make no difference to firm value. They said that the value of a firm without debt is the same as the value of the firm with debt. Another way of saying that is that the value of the unlevered firm is the same as the value of the leveraged firm or the levered firm, and we could write that as V subscript U equals V subscript L. They prove this by saying in a perfect capital market, you can create two firms that are identical in every way except changing their capital structure, and you show that the cash flows to investors who buy a given fraction of the shares in one firm or a given fraction of the debt and equity in the identical but levered firm, those cash flows are always the same, regardless of whether the economy is doing well or poorly, regardless of whether the company made good or bad investments. The cash flows are always the same, so the price of the assets should always be the same. The second proof of that was homemade leverage. In a perfect capital market, investors on their own can create the same leverage that a corporation can create and get the same cash flows and risk resulting from that leverage. So no investor is going to pay a higher price to invest in a corporation that's doing clever things to change the capital structure when that investor can do the same thing on his or her own account. A direct implication of Modigliani and Miller's Proposition 1 is Proposition 2. And Proposition 2 says that in a perfect capital market, the weighted average cost of capital is independent of capital structure. This means that you take these two firms, one firm that doesn't have debt and one firm that does have debt, they're going to have the same discount rate for those free cash flows. We could say the weighted average cost of capital of the unlevered firm is the weighted average cost of capital of the levered firm, or we could write WACC subscript U equals WACC subscript L. And the proof of that is that we have an equation for the valuation of a business. We say enterprise value is the present value of the free cash flows. On the left-hand side of that equation, you have enterprise value. On the right-hand side, you have cash flow 1 divided by 1 plus weighted average cost of capital to the power of 1, plus cash flow 2 divided by 1 plus weighted average cost of capital to the power of 2, and that goes on and on for all of the projected cash flows. Now you consider these two businesses. One business has debt, the other business doesn't have debt. The business with debt and without debt, they have the same enterprise value on the left-hand side. That was Proposition 1. On the right-hand side, you've got all of these cash flows in the numerator in our discounting equation. And regardless of leverage, those cash flows are the same. Remember our definition, after-tax EBIT plus reversing any income statement items that weren't cash flows and then incorporating any cash flow items that didn't flow through the income statement. There's nothing in there that changes if you change the debt versus equity mix. So we have unlevered free cash flows. So if the left-hand side of my equation is the same for firms with leverage and without leverage, and the numerator in all of those discounting parts of that right-hand side is always the same for all the firms with leverage, for a firm with leverage or without leverage, the only thing left is the discount rate. So the discount rate can't change when you change leverage, because otherwise the equation wouldn't hold. So these are the two Miller and Modigliani's propositions. Enterprise value doesn't change when you change capital structure. Cost of capital doesn't change when you change capital structure on a weighted average basis. But the cost of equity changes, and we're going to see how much it changes in the next slide. The weighted average cost of capital for the business is the expected return on the firm's assets on a market value basis. So instead of writing weighted average cost of capital in this equation here, I've instead written the expected return on assets. Now this isn't the return on assets that you might have done in a accounting class or a financial statement analysis class where they take the book value of assets in the denominator and they might take EBIT or after-tax EBIT in the numerator. This is not that. This is the expected return on assets on a market value basis. So it's the market value assets we're talking about here. And that expected return is going to be the return expected to be earned by shareholders times the proportion of equity in the business, plus the return expected to be earned by lenders, the cost of debt, times the proportion of debt in the business. Now suppose that you rearrange that equation to get the cost of equity on the left-hand side. So with a little bit of algebra, we could say the cost of equity is the expected return on assets plus a premium on the right-hand side computed as expected return on assets minus cost of debt times the debt to equity ratio. This equation shows that as you increase leverage, as you increase that debt to equity ratio, the cost of equity is going to go up. The more debt the debt to equity goes up, the more the cost of equity is going to go up, because the expected return on assets didn't change with the leverage. The expected return on assets in their second term didn't change, and so far we haven't changed the cost of debt. Now, in reality, the cost of debt will start to go up as you change leverage, but that's not flowing through to our analysis just yet. So this equation says that as leverage increases, the cost of equity is going to go up. That's just rearranging our equation for the expected return on assets to get cost of equity on the left-hand side. The first part of the equation, expected return on assets, that represents an expected return for bearing business risk. The second part of the equation represents an incremental return investors receive for bearing financial risk associated with taking on debt. So this first part of the equation, regardless of whether the firm has no borrowing or lots of borrowing, that's constant. And in our CVS example, that number's 10%. On the right-hand side, this cost of equity is going up as you increase leverage. And how much it goes up is the premium for bearing financial risk. We can represent that as an equation. Now, this is a very common equation in corporate finance textbooks. On the horizontal axis is the debt to equity ratio. In the textbook that this is taken from, debt is written as B for bonds and S is written as equity, that's for shares. The cost of capital, which is going to have three parts to it, is on the vertical axis. In this example, R0 is the expected return on assets in our example. RB is the expected return on debt or the cost of borrowing. RWACC is the weighted average cost of capital. And RS for shares is the expected return on equity. And that is the graphical representation of the equation that I had on the previous slide. It says is that as you increase the debt versus equity mix, the weighted average cost of capital isn't changing, but the cost of equity is going up. And that equation for the cost of equity is exactly what you can see on this slide here, and that's exactly what you see in this equation written here. Cost of equity is the expected return on assets plus the expected return on assets minus the cost of debt times the debt to equity ratio. That's what appears in that line there. The equation that we've written above is a general equation. It holds regardless of how the market thinks about determining the cost of debt, the cost of equity, and the expected return on assets. So nothing in this presentation on capital structure to this point has invoked any model of the cost of capital. We've just said there is an expected return on assets which is in some way related to risk, and the cost of equity is going to increase as you increase the debt to equity ratio. But you have encountered a very specific case of coming up with discount rates called the capital asset pricing model. And some people like to assume the capital asset pricing model holds. And as we've talked about, the capital asset pricing model is a useful starting point for thinking about discount rates. The capital asset pricing model says that the expected return on an asset, and the asset could be shares or bonds or property or some other asset, the capital asset pricing model says the expected return on an asset is the risk-free rate plus the asset's estimate of beta times the market risk premium. The market risk premium is the expected return on the market portfolio of all risky assets minus the risk-free rate. So the capital asset pricing model says that only one risk matters for discount rates, and that's systematic risk, as measured by beta. Now, we've talked about the model being biased, imprecise and incomplete. So it has these limitations, but we've got to start somewhere, and that's what we cover in this particular course. If you want to assume the capital asset pricing model holds, then you've got the three equations you can see in the next bullet points. You would say on the asset side, invoking the capital asset pricing model, that the expected return on assets is the risk-free rate plus the asset beta times the market risk premium. So there is a systematic risk associated with the firm's assets in general. You would also say that invoking the capital asset pricing model, the expected return on equity is the risk-free rate times the equity beta, so the systematic risk of the shares goes into that equation. And you'd say that the expected return on debt is the risk-free rate plus debt beta times the market risk premium, because there is some systematic risk associated with debt. Now, when we're using the capital asset pricing model and when we're coming up with discount rates in practice, we don't typically use the capital asset pricing model to come up with the cost of debt. But we're using it here because, well, someone might have decided that they want to invoke the capital asset pricing model to do this analysis. You don't have to, and it doesn't actually help you in any way in this capital structure analysis, but some people like to talk in terms of asset beta, equity beta, and debt beta. If you take these three equations for the capital asset pricing model and you stick them into that equation up the top and you do some algebra, what you end up with is the following series of equations down the bottom in which we relate equity beta, asset beta, and debt beta. Here's the equation. You would say that the equity beta equals asset beta times 1 plus the debt to equity ratio minus the debt beta times the debt to equity ratio. Or you could rearrange it a different way and say equity beta is asset beta plus asset beta minus debt beta times the debt to equity mix. Now let me clear the slide here and just illustrate something very important. In our first equation, which is a general equation which holds regardless of whether you want to use the capital asset pricing model or not, we start up with the cost of equity. Cost of equity is on the left-hand side, and I'm going to write that as RE for the cost of equity. The next term was to say expected return on assets, and I'm going to write that as R subscript A. And then we wrote expected return on assets minus the cost of debt, and I'm going to write that as RA minus RD. And then we wrote debt to equity, and I'm going to write that as D divided by E. So what we've written in terms of returns is identical to what's written just above in terms of beta. You've got equity beta matching onto the cost of equity. You've got asset beta matching onto the expected return on assets. Again, you've got asset beta matching onto the expected return on assets. And you've got debt beta matching onto the expected return on debt. And then you've got the debt to equity ratio. It all lines up. So this equation with a star is the beta version of our general equation. That says the expected return on asset equity is the expected return on assets plus this premium for bearing financial risk, which is the expected return on assets minus the cost of debt times the debt to equity ratio. We're going to see that you can talk in terms of asset beta, equity beta, and debt beta if you want, but it doesn't actually save you any computational time. It doesn't save you any computational steps. And when you start talking in terms of betas, there is a higher proportion of students and people in practice that make fundamental errors when they're thinking about those three beta components. You are better off just talking about leverage in terms of expected returns, because that is going to work if you use the capital asset pricing model to come up with the cost of equity, or you use something different. It's always going to work. Whereas people seem to make systematic mistakes when they're coming up with beta via this equation. Now this equation here has got nothing to do with the estimate of beta that we did in our early regression analysis. That's a way that we estimated beta from market prices. These equations here are just quantifying the relationship between asset beta, equity beta and debt beta given some assumptions you already start with. So they're not a different way of measuring equity beta compared to the regression analysis. They are an equation, or a couple of equations, which relate those three beta estimates together. They're not a way that you can go to the data and say, aha, that's a different way of estimating equity beta compared to the regression analysis that we did before. So let's illustrate these equations with a couple of examples. Take our case of CVS, and we're going to consider CVS without debt, and we're going to consider CVS with debt. For the no debt case, let's work out what our expected return is to shareholders over the course of 1 year. Now I know intuitively it should be 10%. That was our cost of equity. And that should match up with what we actually compute as a total return if you account for dividends and capital gains. But let's just verify that in our computations. So what I did was do a valuation of the shares in CVS over 2 time periods. Today, $165.9 billion. And then I just repeated the analysis, assuming 1 year had gone by. We went away, we went to quarantine for a year, then we came back. We examined the cash flows. The cash flows were the same as we initially expected, but we've redone the valuation, and it's a year in the future. Right, so this is just like a bond valuation question we did earlier, where we said, value the bond with 10 years to maturity, value the bond again with 9 years to maturity. Well, what return did you earn over that holding period? Well, in this case, the equity value within a year is going to be worth $179.8 billion as the present value of all cash flows from year 2 onwards. We already worked out there's going to be a dividend of $10.6 billion in year 1. And that means that our dividend yield over the course of 1 year would be 6.39%. $10.6 billion of dividend divided by our initial investment of $165.9 billion, that's 6.39%. The capital gains is the percentage change in the equity value over time, and that is a 3.61% change in equity value. And if you add up the dividend yield and the capital gains, you get a 10% return. Again, thinking about bonds, that was the same thing we did with our bond analysis. If we took into account the coupon payment and we took into account the change in the face value of the bond over the course of a year, that total return, if there were no interest rate fluctuations and no default, would be equal to our yield to maturity. So we verified that without debt, you are looking at a 10.69% return on your investment in CVS, a 10% return on your investment in CVS. Now what happens if I do the same analysis, but I've got $20 billion of debt in the capital structure? We start with equity value of $145.9 billion. We already worked out that with $20 billion of debt, the dividend is going to be a bit lower, $9.6 billion, because we had the $1 billion worth of interest payments. If I roll my valuation forward by a year, the shares are worth $151.8 billion in 1 year's time. So let's see what our dividend yield is and our capital gains are. The dividend yield is $9.6 billion on $145.9 billion, or 6.58%. The capital gains, the percentage change in the value of the shares, is 4.1%. $151.8 billion divided by 145.9, then that should say minus 1 is 4.1%. And if you add up the dividend yield plus the capital gains, your total return would be 10.69%. So just mathematically, forget this algebra on the previous slide. Mathematically, in my spreadsheet, I'm saying the total return to shareholders would be 10% in the no debt case, or 10.69% in the situation of $20 billion of debt. This equation hasn't factored in anywhere yet. But now I can verify that I get the same answer if I invoke the equation. The equation says that the cost of equity is the expected return on assets plus this premium for bearing financial risk, expected return on assets minus cost of debt times debt to equity. The cost of equity was 10%. The cost of debt was 5%. That was the interest rate. There was $20 billion of debt and $145.9 billion of equity in the leverage situation. You work through the computations. That increment in the discount rate for taking on financial risk is 0.69%. So according to our equation, your total return to the shareholder is going to be 10.69%, just like we computed mathematically without even thinking about that equation. So what this tells you is that we have this equation here, which is useful for estimating what the cost of equity is going to be as you put more leverage into the business. But of course, the weighted average cost of capital hasn't changed. Even though your cost of equity has gone up, you've got less equity in the business. So the proportion of equity has gone down, the cost of equity has gone up, and therefore the weighted average cost of capital hasn't changed. To summarise, and we're going to introduce corporate taxes next. To summarise, in the case where you have no taxes, that's our current situation, our leverage assumption is going to be the cost of equity is expected return on assets plus expected return on assets minus the cost of debt times the debt to equity ratio. So in all cases, regardless of whether you think about debt having a given percentage of, say, 30% debt to 70% equity or a given amount of debt, in all situations, the cost of equity is going to be given by this equation. If you decide to invoke the capital asset pricing model and think about debt beta, equity beta, and asset beta, you can do that if you choose, but you must invoke the particular equation that I have used here in coming up with the equity beta, asset beta, and debt beta. And I'm going to work through specific examples in later presentations to show you how these equations all line up. So that's the end of capital structure in a perfect capital market. In the next presentation, we introduce corporate taxes, and then in subsequent presentations, we introduce other market imperfections, in particular, the cost associated with being in financial distress.